This is Trepp Wire Week in Review for week ending May 28th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, President Biden is set to propose a $6 trillion budget with big new investments. And CEOs of the largest banks testified to the Senate banking panel on a host of contentious issues. As we head into a long weekend, the market is quiet, but a number of economic data points were a mixed bag. U.S. durable goods orders were a surprise miss. Jobless claims dropped to a new post-pandemic low. Both housing starts and pending home sales fell in April, and housing prices continue to surge. Manus, during the Senate hearing, CEO Jamie Dimon acknowledged there's a housing bubble, but not like the previous one.
Well, the previous one was all about excesses in lending, or I should say bad hygiene in lending, right? Whether it was commercial or residential, it didn't really matter. We saw it in both parts of the market. Borrowers being allowed to purchase properties with really skimpy amounts of leverage, right? 3% down homes or 0% down homes, long periods of teaser rates on the residential side, and negative amortization on the ARM loans and things like that. So it was really messy on the residential side. We've documented this before on the commercial side, where there was mezz loans on top of B notes on top of more mezz loans, and before you knew it, it was 1% equity by the borrower. Now we didn't really have any of that going into this. All of the excess that we're seeing right now is a function of limited supply and price inflation, and that doesn't mean that people can't get in over their heads and that can't cause problems down the road, but it won't be a function of people taking their eye off the ball on the lending side.
Yeah, so I think Case-Shiller came out this week, 13.2% year over year increase in house prices. And that's up from, I think it was slightly below that. That was for April. That was slightly below that back in March. San Diego and Phoenix are the hottest markets, or the biggest growth markets. We talk about this a lot, but we have a pun intended, no pun intended. We have a generational demand shock that's happening right now, right? And we actually talked about this. I guess we never did the podcast before the pandemic, but early on during the podcast, we talked about this as well, where I don't think there's ever been this many 30 to 35-year-olds like in the US. And even though the knock on us millennials is that we don't get married, we don't have kids, we don't buy houses, well, they all are right now. And partially that's due to the fact that it just started happening a little bit later than usual for millennials. It used to be in your 20s and now it's in your early 30s. And then there was the pandemic, right? So once COVID hit, then it just kind of accelerated everyone who's living in cities, everyone who's living in small apartments or condos or whatever it may be, were pushed even quicker to go look for houses. I mean, I've heard stories out there of, lines around the block to open houses, multiple offers on houses that are just with no pictures, right? Like the house is put up online, they get 7 or 8 offers at ask or above. So it's just a wild, wild time. On the supply side, it's like you're getting the best of both worlds as a seller or the worst of both worlds as a buyer. The supply inputs are way too expensive for these guys to be building rapidly.
One of these days, some unscrupulous character is going to put out a non-fungible token house, right? You're not really buying a house. You're buying something which is like a picture of a house that you don't even get the picture of. You get a token that tells you had the picture, but because it says house, you're going to have, a dozen or 2 dozen 35-year-olds bidding on this thing, thinking they're going to get a roof over their head, right? We're getting into that crazy time where, like you said, people are bidding on things sight unseen, right? No inspection, right? Have to pay in cash, things like that. And it is kind of crazy. And it's probably distorting some of the numbers, right? Right now, you see the low inventory, which leads to low sales of houses, right? If there's not a lot to sell, you can't sell a lot. And the low sale number normally is a function of lack of appetite, but here it's not. So you're getting into these situations where the numbers don't really tell the story. And that may have been true of the durable number today, that if people are paying $800,000 for a house instead of $600,000, which is where the market might have been a year ago or 2 years ago, it doesn't leave a lot of money left over for things like the high-end washer dryer or, you know, that $4,000 stove. I think there's a lot going on right now that is hard to measure. And we did talk about this a few weeks ago, home builders actually tapping the brakes because they can't get supply, right? And they can't figure out how to price a new house right now. So there's a lot going on here, but there's no denying the fact that housing remains a real on fire market.
I think it's kind of weird to call it a bubble, in my opinion. I mean, you know, everything's a bubble in hindsight, right? Like once something goes down, you can turn around and say, hey, that was a bubble. But, you know, I think the demand side of this is not going to subside for a long time, in my opinion, right? Just because of the demographics. Like there are millions and millions and millions of people my age and like, you know, a year younger and a year younger and a year younger than that, who are all going to start moving into houses, going to start, you know, getting married and having kids. And like, you guys can say we millennials don't do those things, but we do. So that the demand side is going to be there. It's just a matter of if the lumber suppliers and if, you know, construction workers and framers and plumbers and everything else, that's where we have the issue, right? Is that kind of lack of supply of labor and material.
Well, you talk about a bubble and you call this not a bubble. What made 2007 a bubble, in my estimation, was this belief that no matter what you paid for your house today, there was no risk because in a year you'd be able to pay, you know, sell it for more. Right. Even if you couldn't afford that house was going to go up $75,000 and you were going to pocket a profit. And people were chasing that. And that's what happens sometimes with stocks when people say, I got to own this stock or that stock because it's only going higher. Yeah. Here, I don't think a lot of these 35-year-olds are expecting to make a lot of money off their house. Definitely. If anything, it's an alternative bubble, which means they have to buy the house because they're thinking if they don't buy this one, it might get more expensive and therefore even harder to support, but not in the kind of way that they're going to profit off of.
I totally agree. Yeah, another data point out this week was from RealPage that rents for apartments were up 1.3% in April. I couldn't tell from the story if that was a month over month number or a year over year number. I'm not sure. But the point is that they're trending upwards, right? And we heard this in the Avalon Bay results, in the equity residential results, that these multifamily indicators were starting to turn back upwards, right? Or turn back to the positive territory. You know, number of showings, how fast units were leasing up. And even in like Manhattan, we're starting to see stories about rental rates kind of plateauing and starting to go back upwards. So I don't know how, they're definitely linked. I just don't know to what extent. So, you know, the higher prices get in the housing market, the more people are going to be probably taking longer to buy houses and have to stay in their rental apartments, or just make a decision to say, I'll wait a year or two. Just to kind of follow up on Manus's point, I had something and I forgot it, but you're not getting a loan these days for a house you can't afford. You know what I mean? Like maybe on the fringes, there are some lenders out there that are being, you know, funky dunky, but like I've been through the mortgage process a couple of times in the last several years, and it is a serious, you know, dissection of your entire life to get a mortgage. And this is for a mortgage that I can like afford relatively easily. So I don't think anyone's like getting propped up by kind of crazy lending.
The no doc is no more, I guess is what you're saying. There is no doc.
There is no doc. It's actually like all docs, like any doc you've ever had.
Well, I was on a call yesterday with a couple of CRE pros, and one guy mentioned the fact that this high price, limited inventory trend on home ownership is bullish for multifamily. To your point, Joe, that it's going to keep people from moving out and keep demand high in that multifamily space. And you know, one anecdote is not a trend to make, but I had a relative telling me this week that she's looking to move within the Washington, D.C. suburbs, and she was expecting, you know, that 1, 2, 3 month freebie, right, to move from one apartment to another. And she said there's none of that anymore, right? Everything is back to being full priced, not a tremendous amount of inventory, and really no deals to be had at this point. So It does seem like we've turned the corner of people getting ready to get back to normal.
We're back, baby. We're back. Did you see the Knicks last night in the Garden? Did you hear the Garden last night? It was unbelievable. I mean, like, it's like either, first of all, you guys got to go watch Charles Barkley talking about it because he almost gets teared up, which is great to watch. But it's almost like either we totally forgot what the Garden was like, or people are just so happy to be out and at a venue like that they are just going above and beyond nuts.
Well, a couple of thoughts on that. Thought number one is the thing that keeps the lid on the Garden being crazy, I hate to say it, is the corporate attendee, right? If you're a lawyer taking a client to the game, you're not painting your chest and you're not throwing out vulgar words and screaming your head off. And yesterday there were 16,000 people. It was not the corporate fan base. It was, the screaming guys from Queens and the Bronx and Brooklyn and everything else. And that's what made it so unbelievably loud, on TV or on the radio, wherever you're listening. But as an aside, when I'm up in New York, and I'm up in New York right now, it takes me about 25 minutes from where I live to get to the Garden normally. And yesterday, my son wanted to go to that Knick game, and he bought himself a single ticket. And to drive in to the city and drive home was an hour and 20 minutes each way, because the city is now so full. There are so many sidewalk restaurants that each side of the avenue has two fewer lanes, or one fewer lane on each side. And there's 1 million people back. The restaurants were full. The city was teeming. And it felt a lot like pre-COVID yesterday.
We're back, baby. We're back. The one other data point I'll round out this conversation with is that single family rental rates are moving up faster than apartment rates. So I think a number out of CoreLogic was 4.3% year over year jump in rents in March for single family rentals. Not surprising, right? It's the same concept we're talking about on the single family purchases. People want their own space. They want more space. So
before we go any further, we should warn our listeners that this is going to be a very positive podcast. We started off with New York, and New York being very strong, and Madison Square Garden being open. They also had 9,000 at the Nassau Coliseum for the Islander game. But through and through, as Martha will take us on this, just a lot of good news over the last couple of weeks. And we're going to try to go through all of that in the next 20 minutes and then get out of here for Memorial Day.
Yeah, right. So let's turn to retail. Retailers Nordstrom and Dick's Sporting Goods reported earnings this week, and the reaction from investors could not have been more different.
Well, I think the headline for this earnings season has been just an outstanding run for retailers on the top line and on the bottom line. Dick's this week had great results. Others over the last week or so, Dillard's, Kohl's, Macy's, Abercrombie and Fitch, Walmart, Home Depot, all just really, really terrific results. The one outlier was Nordstrom, and even they beat on the top line, but disappointed kind of overall. Their stock was punished as a result. And they talked about that on CNBC quite a bit, about them being kind of the outlier on the downside. But, these are not essentials that we're talking about, the names I'm rattling off, right? Dillard's, Kohl's, Macy's, Abercrombie and Fitch. These are as non-essential as you get. And for these guys to beat as handily as they did, it is a good sign for the market that people are ready to come back and spend and get out and shop. And that's a good thing.
I thought the e-commerce numbers were interesting for each of them. Nordstrom said that nearly half of its total sales in the last quarter were e-commerce, compared to Dick's, which had 20% of their total sales were digital, which is kind of an interesting data point.
Well, I think it's great. I love seeing those numbers. I love seeing these companies like Nordstrom, not really, but like Dick's, that is expanding its brick and mortar while also expanding its e-commerce. And I will say, so yesterday when we were on the podcast prep call, I was outside of Men's Warehouse. I was picking up a tux for a wedding that I'm going to on Saturday. And then I popped across the street and went to the PGA Superstore. And OMG, it was like Shangri-La for me. I didn't buy anything, but because I went in there with no plan. I got to go back with a plan. But the reason I'm bringing all this up is because for Dick's, I think, Martha, you brought this up before the call, golf is on the up, right? Like last year, the number of rounds and the number of people playing golf just skyrocketed because it's one of those things you can do outside with your friends during COVID. And I think you put a number in here that number of rounds of golf played in the US rose 24% through March, according to the National Golf Foundation. March alone saw a 45.3% surge from a year ago. So people are out. And Dick's is one of the only places that's usually like a local sporting goods store that has any golf equipment. I mean, if you're a real golfer, you don't buy golf stuff at Dick's, but
Ouch.
I'm just saying. I mean, you can buy clothes and stuff, but you don't trust their virtual, what you call it, when you hit the ball into the screen, like they're adding like 20 yards to you. So just let it.
It's true of a lot of things, right? You would never buy a football helmet at Dick's or hockey skates, right? You go to the specialty store. You're there to get your running shoes, your running shorts, right? Camping gear, right? And anything for your kids because they could use anything. But for the adult softball glove, you got to have the state of the art.
You guys are snobs. You're kind of sports snobs.
Listen, when you're playing, like when you have like one thing in your life that you actually care about, like for Manus, it's hockey, and for me, it's golf. So you gotta go all out.
So we talked about retail sales and how good those were. The positive news we saw in the retail space was not really just limited to brick and mortar stores. It did spill over into some really nice stories in the CRE finance world. I'll run through a couple of them that we talked about this week in our research, our daily research. First up, we saw the Willowbrook Mall was refinanced into a new 2021 single asset deal. The existing loan had $177 million balance. It was issued in 2011, so it was a 10-year loan. In 2020, the loan posted a DSCR of 141x when occupancy was 98%. The mall itself includes Macy's, Dillard's, JCPenney, but they're not part of the collateral behind the existing loan. The new loan was made by Brookfield and the New York State Common Retirement Fund. They made a $155 million loan to take out the existing debt. So why is this important? One of the reasons is we've talked long and often about how securitized mall loans that were made in 2011 and 12 may struggle to get refinanced. Here you have a case of a really big loan getting new money coming in. The new money is less than the existing loan amount, but nonetheless, the existing loan will be paid off, and that's a positive story. Another similar type of story, in this case, the property is the Court at Oxford Valley. It's a 450,000 square foot piece of collateral in Fairless Hills. It's a regional mall. It has a Dick's and a Best Buy among its collateral tenants. The loan is slated to mature in July, and recent special servicing notes indicate that the borrower is expecting to pay off the loan in full. This is a CMBX 6 loan, which is terrific. And then lastly, the Strip, which is a property in North Canton, Ohio. It had several tenants whose leases were coming due later this year. One was Walmart coming up in October 21, and the grocery store Giant Eagle. Combined, those tenants had 30% of the space. Giant Eagle's lease was supposed to end in early 22. Both of those firms have extended their leases for at least 6 years. That particular loan is part of a 2016 deal, and now some of the uncertainty behind that rent roll now goes away. So really positive momentum in the loan space right now, and we feel good about that.
So while we're on the subject of retail, in New York, commercial retail rents have dropped, and that's providing some good deals for new businesses. And some of them are a little off the beaten path.
Like tattoo shops or
tattoo removal, maybe.
Oh, tattoo removal.
A breakfast taco. It's a story that was in the Wall Street Journal highlighting that it's a new opportunity with rents down 10 to 50%.
Axe throwing?
Maybe. Although
Wine
in New York, I don't know
painting?
if that's a good idea.
I think one of the most interesting stores I ever went to was in Boston. It was a bodega. You walk in and it's like, 20 square feet, and it's got like, you know, the plexiglass and everything, the bulletproof glass. And then like, if you go to the back and turn the right particular Cocoa Pebbles box, it opens a door, which then you go to the back and it's like this amazing shoe store, like one of those like Nike Air Jordan type places. But anyway, I digress. I think what's interesting is that the pandemic really, really hurt a lot of restaurants, although not as many closed as you would have maybe expected. But coming out of this, due to the fact that rents are lower, like it opens the door for a lot of potential new owners or old owners to open up new restaurants, notwithstanding like the tension they may face when trying to fill jobs.
Yeah, I always scratch my head when I see these specialty retail operations, and I wonder how many people you have to get through that store to buy something and how much demand there is. I remember in the early 2000s, one of our long-term clients who's still in the market and is still a regular confidant for us, he and I were going to lunch one day and we passed a caviar store on Park Avenue. And this was probably 2004, 2005. And he was a little bit early on his call, but he turned to me and he pointed to it and said, that is the market top. When you're putting a caviar store on Park Avenue, right, that indicates that we are near a commercial real estate top right now. The top turned out to be 2 or 3 years away, but it was an interesting observation. And for me, you know, some of these other things that you're referring to just make me wonder, you know, if it's one thing, if you have the city expectation being 95% of what it used to be in terms of traffic, maybe you can support some of these unusual outposts. But if it comes back at 75%, you know, I'm not sure a guy who's selling just belts is going to do very well.
Crocodile belts only.
How many belts do you need?
Not from Kohl's. Let's turn to office. Research has shown that most employees prefer a hybrid work model, and that's creating some new challenges for employers.
Yeah, I think it's a real problem right now, trying to get your arms around how much space you need. Somebody was saying on television, I believe, or maybe it was one of my calls this week, nobody wants to work on Mondays and Fridays, and everybody wants to work on Tuesdays and Wednesdays. But if you have this notion that only 60% of your people are going to be in on any given day, what happens when everybody comes in on Tuesday, Wednesday, Thursday, right? And that's a great question. And I think owners of properties are wrestling with this right now, what their demand will be, how to price this stuff. And I think tenants as well are trying to get their arms around what's the right number to renew for. Is it 75% of what I had, 50%, you know, or do you take the whole thing and just demand a much lower price? I think it'll take a while for this to wash out. You know, as I said about New York before, I think the signs are positive, that things are happening, people are coming back, but I do think that demand will lag for quite a while, and there'll be some bumps in the road along the way.
Yeah, I'm not sure if I mentioned these numbers last week, but Newmark sends out a nice update of New York and just more broadly office leasing and sublet space and stuff. And there has been a slight slowdown in the number or in the square footage available in terms of sublease space in New York and other cities. Some companies are taking space off the market, which is good to see. We also saw in there from Castle with a K, the security systems. Did I talk about this last week? I think we did, but that's okay. In case you missed it, I think the number was about 14% in terms of Manhattan office buildings, or maybe it was New York City office buildings versus pre-COVID levels of security card swipes coming into the office. I think it's more like 24, 25% if you do like a big 10 city average. So it's still like a long way away from getting people back in the office, you know, more regularly. I will say, I'm sure the software plays are already out there. I'm sure there's all sorts of companies that have sprouted up to provide like scheduling services and stuff for different companies. But, you know, to me, if I'm going to do this hybrid thing, and I'm going to be home on Mondays and Fridays, I want to get all my like nitty gritty work done on Mondays and Fridays. And I want Tuesday, Wednesday, Thursday to be all the meetings, right?
Meeting days.
Right, exactly. So with that in mind, just thinking about Trepp's offices, like we have tons of rows of desks, right? And we do have a decent amount of meeting space. The new office may have to totally reallocate that. It may have to be like 70% meeting spaces and 30% desks. And you just rely on, people to kind of hang around. Like maybe it's the WeWork thing. Go sit on the couch with your laptop if you're not in a meeting, or stay home if you're not in a meeting and just get your work done, So, we mentioned it last week. We had that office roundtable, with definitely worth a look. But, like I keep saying, every CFO is looking at their cost savings from the pandemic, and they're thinking, what can I get away with? So I think we should be really paying attention to lease maturities over the next 2 years or so. It's going to be very bumpy.
On that point, I'll flip to a shameless plug. In our research every morning, we're constantly looking for stories of tenants terminating leases, moving offices, and so forth. And that is such a sign of potential future distress. And we had 3 or 4 of them this week that we highlighted. One of them in San Francisco. This is at 1019 Market Street. The collateral is about 75,000 square feet. Zendesk is the top tenant, 97% of the space on a lease that ends in August 2022. They're paying about $55 a square foot. They have notified the servicer that they intend to terminate their lease at this point early. So, these kind of signs are out there for CMBS buyers or for CMBX longs and shorts. And often when these things happen, they do become problems down the road. Some other ones we talked about this week, Dun & Bradstreet, they're the sole tenant in a Center Valley, PA property. They had originally said that they were going to sublet about a third of their space. That came from a reporter, John Harris of the Morning Call. He broke that a couple of months ago. This week it came out that D&B is going to now look to outsource a lot of their work to India. So that makes this loan even more concerning. It's a $28 million loan that makes up 4% of a CMBX 10 deal. Another similar thing in Baltimore, they're a education operator with 50% of the space in a building has terminated its lease. Right. This is another case, CMBX 12, $25 million loan. And just to kind of talk about, how these things play out, we had follow-ups this week on other stories of similar note. A couple of years ago, we talked about Newmont Mining leaving a Greenwood Village, Colorado office, right? They were going to not renew their lease. That was a $72 million loan that was part of CMBX 9. This month, a couple of years later now that Newmont has left, the collateral value was cut from 113 million to 80 million. Still above the loan balance, but a lot less equity there to protect the bondholder, the note holder, what have you. A similar one in 2017, we told people to keep an eye on this Minneapolis suburb office in Hopkins, Minnesota. Cargill was the sole tenant. They were vacating. It turns out that this month, the value of the collateral was also cut and the loan went 30 days delinquent for the first time. So, these stories do have legs. Sometimes you find out about them 2 or 3 years in advance, and it's worth keeping an eye on because over time, these stories can go from just something to keep an eye on to something that becomes real. And that's why we highlight them in our daily research.
You should be receiving Trepwire in your inbox every morning. If you're not, come on.
That was our shameless plug.
You also had a story, Manus, on AARP, and there's an allusion to a band in that story that
an allusion, right? Not an illusion,
allusion, right. A musical allusion to a band.
Yes, this particular story was the Rockville Corporate Center loan. The loan is $32.8 million. The second largest tenant is AARP, and they won't be going back to Rockville. And for those that were fans of the band REM, one of their early hits was the song Don't Go Back to Rockville. And so in our research this week, we noted that AARP, with their 34% of the space in this particular office, would not be going back to Rockville. So sometimes not only do we have fun on our podcast, we have fun in our written word as well.
You might have to be an AARP member to understand that REM reference. Because I think I know REM, but I definitely didn't know that one.
You didn't know that song? Oh yeah, you're under the demographic there.
It was one of the real early things before they kind of
Yes.
became
I
more
could sing it for
commercially
you, but
viable.
I won't.
Before they sold out, man.
So let's go to some good office news.
So let's see what we got this week. We already talked about a lot of good retail stuff. Let's talk about some good office. One of our top stories this week, Boston Properties is buying 360 Park Avenue South. It is a fully vacant Manhattan office tower, sold for $300 million. That story came from Commercial Observer. The property is in Manhattan's Midtown South neighborhood. The buyers are Boston Properties. The property backs an existing $203 million legacy CMBS loan that, might have been considered dicey at some point when you consider that the sole tenant had left a couple of years ago. That particular loan backs a Morgan Stanley deal from 2007. The loan matures in March of 2022. It can be paid off later this year. We wrote back in 2009 that publisher Reed Elsevier, I don't know if I pronounced that correctly, was the sole tenant on a lease that ended in late 2021, but they left quite a while ago. So why does this particular story matter to us? It matters because here again, you have a well-regarded property owner in Boston Property making a bet on New York City that it's going to come back, that they're going to come in here and be able to lease up this particular asset in short order and turn this particular asset, which they're paying $300 million for, into something substantially more. So a real vote of confidence. We like votes of confidence, especially in New York. And my other story, Fortress Investment and Ocean Capital, they sold off a 125,000 square foot Class A creative office to Pendulum Property Partners. This property is called The Link. It's a lot of film editing, broadcasting, and post-production type tenants. And again, in this particular situation, you're never quite sure what California is going to look like coming out of this pandemic, right? Economy hit hard, just like New York. A lot of companies fleeing the area, not quite sure what demand will be for offices there. And again, here we have a nice sale of a property that wasn't particularly highly occupied. I think it was 75% or thereabouts. So another vote of confidence for a market that you weren't really sure where it stood 14 months into the pandemic.
So slight diversion, but you made me think of it with the post-production and all that other stuff. Did you see the Amazon deal where they actually came out and said they are buying MGM Studios, basically to bolster their Amazon Prime streaming service? But more importantly, we got a good tip from one of our loyal listeners, Yanni, who appreciated our talk on the movie theater stuff in terms of retail last week. But he had pointed out that, in the more densely populated areas, a lot of these movie theaters have large parking structures attached to them that are kind of part of the property. And then that part of the property is actually very valuable in densely populated spaces. So while the repositioning of the theaters themselves is tough and expensive, and that's true, the land value alone and the kind of just the space value alone in the more densely populated areas is, not to be underestimated. So I love that about the podcast, right? We say stuff and then we get people who listen who do this for a living, this particular niche that we talked about. They'll shoot us an email and say, hey, this is what we're seeing on the ground. I love that.
One more thing about that 360 Park Avenue South deal. Let's call that the deal of the week, because it was going to be my deal of the week. Let's give credit to CBRE, which brokered that particular transaction. Darcy Stakem, Bill Shanahan, and Doug Middleton brokered that deal. So, that's our deal of the week.
And looking at hotels, we had a couple of stories on payoffs and some extensions and other tidbits that you were going to cover, Manus.
Well, we did say early on in the podcast that we're going to have some really good news this week, and it really extends across just about every property type. Another story that I love this week, The Real Deal was reporting that the JW Marriott Le Merigo Hotel in Santa Monica, California has been sold for $75 million. The property is a 175 key full service hotel that was built in 1999. The hotel backs $57 million in CMBS debt split between two 2015 deals. The loan was slated to mature last November. It was modified to have a 12-month extension. It was valued at $104 million in 2015. So the new sales price represents about a $30 million, 35% drop in valuation. But when you consider that in 2020, DSCR was negative and occupancy was 52%, this is another sign of life in a market that was battered last year. The buyer was reported to be Stockdale Capital Partners. So we love that. Another story that we talked about this week, the $44 million Marriott Troy, Michigan loan. A modification is under consideration right now. There are some details in the special servicer notes that were revealed. When you start seeing specifics come out of the special servicer notes, that usually means an extension or a modification is close. In this particular case, the loan would be extended till the spring of 2023. There would be a 5% principal curtailment that would accompany the extension. In this particular case, the collateral is a 350 key full service hotel. The property was last renovated in 2014. The loan was slated to mature in February of this year. It was delinquent going into this. So if this particular loan gets extended and there is a 5% principal curtailment, you would once again call this a happy story for the market. It's a case where the borrower felt confident enough in the asset to put more money in, to seek an extension, and the special servicer saw enough green shoots in the market or the property to say, yes, we can go ahead with this. So votes of confidence on either side with a deal like this, should it come to pass.
Man, as I was doing some of these roundtables and client calls and stuff this week, and we actually had some really good ones. We had some people from Newmark, like specialists in the different property types on, which were great. But one of the themes that I was getting across to some of our clients who are not really in the CMBS space per se, they're more just plain old commercial real estate. I was telling them about all this forbearance that happened, right? And the delinquency, shooting up to almost all-time highs in June, and then, coming decently down, right? From 10.32 down to in the sixes now. But I kept talking about like that potential forbearance wave. Do we know how any of these forbearances coming out, like these loans that are coming out of forbearance, how they're performing yet? Or is it too early to say?
I don't think it's too early to say. I think that, what we're seeing right now is a situation where in hotels, for example, we've turned the corner, right? We have seen, and I don't want to give too much of this away because we'll talk about it next week, and the numbers are not fully baked, but from the peak of June 2020 to today, we've seen about a 10% fall in the percentage of hotel loans that are delinquent. We have seen a complete reversal in terms of the number of borrowers looking to go deed in lieu, to throw back the keys, right? We're seeing loans that were delinquent getting cured. We're not seeing a guy very often, or a gal, ask for a third forbearance, right? I think people believe that the worst has happened, demand is coming back. If they've come this far, they can make it to the finish line. And I think that these numbers are going to continue to topple throughout the rest of the summer. It's a really, really encouraging story. And it's one that I think all the parties involved should take a victory lap, right? The regulators for suspending the REMIC rules, special servicers in the industry for coming up with these creative use of FF&E reserves to keep loans current. borrowers from digging deep and saying, we're going to try to keep this thing going by hook or by crook, and, attaboys for everybody. I think this is great. This could have been a 2008 subprime-like disaster, and it's not.
Just for all you listeners out there who are going to email us and say, what are you, crazy? This is the end of the world. Market's still going to crash. Like, that's okay. Maybe we'll have a negative episode next week. But today, it's the positive episode day. All right? As my daughter screams and cries in the background.
Yes, I do. I do hear it.
I'll mute myself
not
now. Thank you
happy
very
with
much.
this comment. So
she's a perma bear.
I think in her gibberish, I hear her saying, "You're going to get yourself canceled, Joe. Stop.
Probably. Yeah, no doubt. So shout outs of the week. Joe mentioned Yanni M, who commented on the theater story that we covered last week. John D, who reached out to Manus. He likes a lot of the topics that we cover. Ian M, as a Siri investor, I love listening to the podcast, and he enjoyed the episode with Dr. Eva Steiner, which was released this week. If you haven't had a chance to listen to it, it's worth a listen. She's very knowledgeable on the hospitality industry and the industry at large. So it's worth a listen. Ginger R shared our episode with Dr. Eva, and she loves our podcast. She says that it's one of her favorites, and that while we spend a lot of time talking about CMBS, she likes all aspects of commercial real estate, so enjoys that. BB Dogged Tenacity on Twitter quoted some of the stats from the movie theater episode. And Joe, I'm going to make you blush a little bit. I'm going to recognize you as a winner of the Next Generation Award from Connect CRE. So a round of applause for Joe there.
Yeah, I don't know how that happened, but thank you.
We have a very busy team.
It's one of those funny, weird things where, like, you guys posted something on LinkedIn and everyone's liking it and commenting and stuff. And I'm like, I want to be a good corporate citizen and engage with the post and like the, and I'm like, I can't like a post that's like
about yourself,
about me. Yeah. It's very odd for me. Like, as much as I like put my foot in my mouth on this podcast all the time, it's different like online, like on Twitter or whatever. Like, I don't ever want to post anything online that will be there forever, except for a podcast.
That's an interesting way to go. I think if I was ever honored with such a distinguished, citation as you're getting right now. I think he's
poking fun at you a little bit.
No, I think, before I ever showed the guy my license at TSA, I'd be showing him this press release. Like, before I show you this license, I want to show you this other thing, just like, it's like scoring the big goal in a big game. You want everybody to know.
Oh man, I don't know where to take that. Maybe to the close this weekend, which we are all looking forward to. Do you know that possibly about 37 million Americans are expected to travel? And not surprisingly, or maybe surprisingly, I guess, Las Vegas and Orlando are going to be the top two spots for travel. A heads up, if you're taking to the skies, the TSA is going to extend the mask mandate. I can tell from personal experience, just having been on a plane, you got to wear the mask.
Well, I can tell from TMZ that I got a 50-50 shot at getting my hair pulled out and punched in the face if I get on a plane anytime soon. I will say that the TSA numbers are interesting. There was one day last week where we were at 90% of where we were in 2019 in terms of TSA pass-through. Now, if you look at the past 5 days, we're at 73% of 2019 numbers, but I really am going to be interested to look at these numbers after Memorial Day weekend to see where we're at. And I can tell you that I will report back to you after the last week in June when I'm bringing my 2.5-year-old son on a plane. And I'm like literally shaking in my boots about how I'm going to keep a mask on that kid, and or how I'm going to prevent my wife from getting into fisticuffs with somebody who yells at my son for not keeping his mask on.
Somebody who has raised 5 kids and is willing to take endless grief from people telling me I'm a bad parent. That's what Benadryl's for, my friends.
Someday, Manus, you'll have to tell the plane story with your kids.
And with
Yes.
that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Have a great weekend. Thank you for listening and stay well.
All right.